The RBI just cut rates big time. What does it actually mean for you? Let's break this down nice and easy. On June 6th, the Reserve Bank of India surprised pretty much everyone by slashing the repo rates by 50 basis points. That is not a small cut. It's a bold move. It's the biggest we have seen in one shot in over 5 years. The new repo rate now stands at 5.5%. But that's not all. The RBI also announced a 100 basis point cut in the cash reserve ratio or CRR, basically freeing up an additional 2.5 lakh crores that banks can now lend out. Quick detour, what is CRR? It is a percentage of a bank's deposit that it has to park with the RBI earning no interest. It is like a forced safety deposit box, money that banks cannot touch or use. By cutting CRR, the RBI is saying that you don't have to keep as much locked up with us, go ahead and lend it to people or businesses. So, this move releases a lot of idle money back into the economy. Before we get deeper, quick reminder, if you enjoy this kind of simplified take on finance and markets, hit subscribe and join my Telegram group. The link is in the description. Also, if you're serious about a finance career, I've just launched a weekend course to help you become a SEBI-registered investment advisor. No jargon and no MBA needed. Okay, back to the RBI. Why did they go this big? A few reasons. First, inflation is low. CPI inflation for April came in at 3.16%, the lowest in 6 years. That gives the RBI some breathing space to support the economy without worrying about prices shooting up. Second, while GDP is expected to grow at 6.5% this year, that is not exactly roaring growth, especially with global uncertainties like trade wars, oil prices, and elections in big economies. So, the RBI is trying to get ahead of the curve. Think of it as them saying that we'll support growth now while we still can. They are also trying to signal something like we are serious about boosting credit and reviving the economy. That is why they are not just cutting rates but also pumping liquidity into the system through CRR cuts. It's a double push, cheaper money and more money. Now let's talk about the impact. The markets loved it. The Sensex and Nifty both jumped right after the announcement. Bank stocks especially went up because rate cuts usually mean more loans, better margins, at least in theory. Bond yields also dropped, which is a fancy way of saying that investors now expect lower interest rates to stick around. Even the rupee gained a bit, which is a rare after a rate cut. That shows how much optimism this move has generated. But here's the thing, and this is where it gets interesting. Just because RBI cut rates does not mean that banks will immediately pass that on to you and me. That is where transmission comes in. How much of this rate actually gets reflected in EMIs, business loans, and credit lines? And historically, Indian banks have been, let's say, a little slow with that. One reason is deposit pressure. Banks need to pay a decent interest on deposits to attract money, but if they cut lending rates too fast and too deep, their profit margins, called NIMs, take a hit. Right now, the average lending rate on new loans is around 9.3%, and deposit rates are around 6.3%. That gap is already very tight, so banks are a bit hesitant. Yes, the CRR cut gives them some cushion, but they are still watching their backs. Plus, deposit growth is sluggish and credit growth has actually slowed down to just 9.6% compared to over 16% last year. In short, banks have money but they are not in a rush to lend. Why? Risk, especially in segments like MSMEs, personal loans, and sectors exposed to exports. Non bank financial companies or NBFCs play a big role here. They step in where traditional banks hesitate. NBFCs are often more flexible, faster, and more aggressive in reaching the last mile borrower, whether that's a small business owner in a tier 2 city or someone buying a second hand vehicle on EMI. But there is a trade off. NBFCs take more risk and they lend at higher interest rates to compensate for that risk. Their customers are often less creditworthy by traditional standards, which means there's a higher chance of default. With liquidity tightening and defaults creeping up, even NBFCs are being cautious now. Finally, this brings us to the RBI's biggest challenge. Can this rate cut actually restart the credit engine? They have done their bit, that is, rate cut, liquidity, and change in stance from accommodative to neutral, but now it's up to the banks and borrowers. And if you're wondering what neutral stance means, it is RBI's way of saying that we are pausing for now, but if needed, then we'll cut more. But we'll wait and we'll watch the data. Meanwhile, inflation might creep back. Oil prices, gold spikes, and even food. If any of these spikes, RBI may have to change course again. They have projected inflation at 3.7% for FY26, assuming a normal monsoon and stable prices. But that is not guaranteed. Also, foreign investment is down. Only $1.7 billion in FPI came in last year, and FDI has slowed too. If global investors don't feel confident, then the rupee could weaken again, which adds another layer of pressure. So, where does that leave us? If banks actually lend, especially to consumers and small businesses, this could be a turning point. Lower EMIs, more home loans, revived construction activity, maybe even some job creation. But if banks stay cautious, then we might just see a lot of liquidity sitting idle. The bond market may look happy, but the real economy won't move much. RBI's message is loud and clear. We have opened the tap, it's your move now. Before I wrap up, a few quick things. If this helps you understand what's going on without feeling overwhelmed, subscribe to the channel. I do this regularly. Join our Telegram group for updates, discussions, and exclusive content. And if you're thinking of making a serious move into finance, especially if you want to advise people professionally, check out my NSM 10th course. It's a weekend only, beginner friendly, and tailored for people like you who want to build a real career. Until next time, stay curious and stay informed.